everyone, this is Roger Scott from Market Geeks with your daily trading video tips. Before I begin, I'd like to remind you to visit MarketGeeks.com for your free swing trading report. Stock trading volume analysis is a very important step in stock analysis when done correctly. Traders who follow Market Geeks sometimes notice that I don't write many articles about trading volume. One of the reasons why I avoid this topic is because most beginners get confused and overwhelmed when they perform stock trading volume analysis. Trading volume in general is very elusive and more often than not does not provide information the traders can benefit from unless the trader really knows what to look for and how to correctly analyze volume. Volume in the stock market is a measure of market activity. This in turn reflects how much buying and selling interest a particular stock currently has. Because volume reflects accumulation and distribution, traders are able to determine emotional reaction to fundamental and technical news based on volume analysis. You should also keep in mind that volume analysis can be performed on a weekly basis, daily basis, and even intraday basis as well. One of the reasons why volume analysis is difficult is because volume is cumulative, meaning you don't get to see buying or selling volume unless you glue yourself to the ticker tape and begin monitoring every trade that occurs for each stock. This is very impractical and will not yield you productive results. One technique I do find useful for incorporating volume into my daily trading is to use volume spikes. By definition, a volume spike is a dramatic increase in daily volume that's substantially greater than the daily average volume of the market you're trading. In this example, you can see what volume spikes look like. I typically want to see volume increase 300% over the average daily volume. Look for a stock or ETF that demonstrates average daily volume at least 3 times higher than the average daily volume. The volume does not have to be one isolated day, but can be a cluster of up to 4 trading days. The key is to mark the high and the low price that traded on the day that had the most volume. You want to see what the highest price was and the lowest price was on the day the highest volume occurred in this volume cluster. Once you isolate the high price and the low price that occurred on the highest volume day, pay attention to the direction of the trend. If the stock is headed upwards, you only need to pay attention to the high price that was traded on volume spike day. If the stock is trending downwards, you only need to pay attention to the low price that traded during the volume spike period. You would enter your long position on the first closing price that's trading above the spike high. If you're going short, you would enter a short position on the first closing price that's trading below the volume spike period low. In this example, you can see how the stock was trending up prior to the spike day. You would only focus on the long side and enter a trade market on close, that's MOC, when the market is closing above the highest price traded on spike day. You can see the entire progression in this example. We begin by determining the direction of the trend. Afterwards, we isolate the volume spike and determine the lowest price reached that day. We then closely monitor the position for a closing price that's below the spike day's low. In this particular case, the low occurred the next day following the spike low, and we enter the market at the close or MOC. I tend to place the MOC order during the last 5 minutes of the trading day when I'm confident that the closing price will be below the lowest price of that day. Oftentimes, if the market is really volatile, I will watch the market and just place a market order about 2 minutes before the closing bell. I suggest you get to know how fast your trading execution platform is and how volatile the stock is so that you're sure to get executed before the closing bell. When analyzing stock trading volume, you should only pay attention to the extremely high volume days that are at least 3 times higher than the average volume day for the stock you're trading. Always notice the direction of the stock before the volume cluster and notice the high and low prices that were traded the day the highest volume occurred. Enter long positions when stock closes above the high that was reached during the volume cluster, assuming the trend was up prior to the volume cluster. Reverse these instructions with short positions. Thanks for joining us for today's tutorial. Don't forget to visit MarketGeeks.com for your free swing trading report today. This is Roger Scott wishing you the best in your trading.